Welcome to episode 5 of Investing 101. My name's Charlie, and today I'm going to be telling you how to find and evaluate stocks with room for growth. The first thing I'm going to tell you about is called a stock screener. A stock screener allows you to sort by specific criteria and find stocks that fit those criteria. Making your own set of criteria can help you find exactly the kind of stocks you're looking for. Now, I recommend using the free Yahoo Finance screener. It'll allow you to use your own set of criteria as well as check out other existing criteria or sets of criteria that exist. On the Yahoo Finance website, you can search through existing criteria and try to find those that match what you're looking for. Right now, I'm going to tell you about one specific type of criteria and values you might want to look for. One important number to understand in finance is called the PE ratio. The PE ratio is simply the price of a stock divided by the earnings that stock made in a 12-month period. For different industries, this PE ratio is typically higher or lower. For innovative tech stocks, the PE ratio is usually higher, and for more concrete mining stocks, for example, the PE ratio would be lower. In episode 2, we touched on how companies with higher growth rates typically have higher PE ratios. This is because the earnings can be expected to catch up to the price due to the high growth rate. The PEG ratio can help quantify this, comparing the PE ratio to companies' growth rates. This can give a more straightforward number that takes into account the growth the different industries or companies are experiencing, which can help make sense of high or low PE ratios. In theory, the fair PEG ratio is 1. This would mean that the company's PE ratio is exactly in line with the growth the company is experiencing. A PEG ratio of greater than 1 may suggest that the company is overvalued, and a PEG ratio of below 1 may suggest that the company is undervalued. However, the PEG ratio alone is not enough to conclude this. So, one criteria you could use for your stock screener is looking for companies with PEG ratios of below 1. However, this doesn't cover all information. For example, if a company has a fear of collapse or if a resource is running out, a company may drop in price and the PEG ratio will come down along with it. And that doesn't mean you should automatically buy. Another piece of information you can utilize is the opinions of professional analysts. On the Yahoo Finance website, there's a tab on each stock that gives you professional price targets and opinions on each stock. This can give you some sort of idea of what common opinions are and what the general consensus is on the direction the stock is moving. This doesn't give a complete picture, and it's no real sign that the stock is going to go up or down, but it is another piece of information you can consider. If you want to know more about any of the criteria that exist, feel free to do your own research. While the names can seem confusing initially, you can figure them out if you put time into it. The process of finding and evaluating stocks with room for growth is a difficult thing to do. People spend years in college and years after college trying to figure out the best way to do it. However, it can be done at a base level by anyone. I recommend doing either of the following. 1, you could look at a stock you already know about or a company you're already interested in and try to figure out whether or not people think it's going to go up or down and look at some of that criteria that you were finding before. Or you can use a stock screener and then find stocks that fit those criteria, then do further research into the qualitative aspects of the stock. Quantitative information is like a PEG ratio that can be determined by a number. However, qualitative information like shifting industries and war going on in the world cannot be determined by a number, which means it is qualitative information. Thanks for watching. I hope this video helped you understand how to find and evaluate stocks with room for growth. And this series helped you to understand the stock market and trading a little bit better.